Okay, let's start. I just updated this morning to let you know the most recent data we have on the COVID-19 coronavirus. So I'll be discussing this in depth. On one hand, the medical issues associated with the COVID-19, and then which is the contagion mechanism into the global economy, and which could be different impacts. Here I would be distinguishing between short-term impacts from mid-term impacts, which I think could be more relevant for valuation of companies. This is what we have as this morning. 80,000 people have been infected. As you know, 2.7 thousand have died. Up to now, almost 98% of the infected cases are in China, or 88% are in the Hubei province. It is relevant to understand that at the end, let me get my notes here. If you divide the number of infected people in Hubei by the number of people who live in Hubei, the infection rate is 0.1%. So I think it's very relevant to look at this data, okay? Because sometimes I think in this kind of social network environment, things seem much worse than they really are. Medically speaking, 0.1% infection rate is not that dangerous. The other key factor to consider in this virus, which is the contagion rate, but it seems to be 2 to 1. Okay, 2 to 1 is also very healthy. It's not a very powerful virus in terms of dissemination. Normal cold is above 2 to 1. Okay? And you had cases where the contagion rate was well above this. The problem, of course, was that the virus started on the 8th of December, and it only was recognized by the 7th of January. So in the meantime, if you didn't apply any measures, even though you could be having a 2 to 1 contagion rate, if doctors are infected, then the contagion rate in a hospital could go up to 500 to 1. So it was a question of the origin. It was not well managed. Also, when the local head of the Communist Party in Hubei announced that this was a reality early January, he went to the TV at 2 o'clock a.m. He said that by 10 o'clock a.m. there would be a quarantine imposed in Hubei, and in Wuhan, and in Hubei. And it seems that if you look at Wuhan, 11 million people living, 1 million people left in those 8 hours. And this also facilitated the spread of the disease outside the US. We'll also, outside China. We'll also have to look in the evolution of the rest of the world. But the key issue to watch here is not the number of infected people, but the delta, which is the net increase of new infected people. Okay, once you have applied decent quarantine methods, this should come down. In the case of China, the delta was 3,000 a day. Latest data has been below 300. I think it was yesterday. So what this means is that once you apply the quarantine, it seems that the delta goes down. The worry now is the delta from the rest of the world. That, as you know, we had the situation with a cruise ship that had 300-400 people infected, and then we need to see on a daily basis the evolution of new cases versus the previous day, okay, in places such as Japan and especially Iran. Another factor to look at here is the fatality rate. The fatality rate today stands at around 3% in the case of China and 0.6% in the rest of the world, which probably means that not everyone which has the disease has been diagnosed in the rest of the world. And that's why you should be expecting that in the coming days, you should be expecting a higher number of people infected, but really they are already infected. To understand how you realize the diagnosis, you apply a methodology called PCR, which is a little bit expensive, but tells you whether you have infection or not. Okay. In the case of China, they didn't have enough PCRs. That's why the medical community advised China a few days ago, okay, now everyone who enters into in the hospital with a serious respiratory disease should be considered as COVID-19. And that's the reason why you saw 15,000 cases last weekend, just in a single day. It was because of the change of methodology. Okay. If you compare this fatality rate with other diseases, it's not that bad. SARS was at 10%, MERS, Middle East respiratory disease, 30%, Ebola, 50%. And finally, we have to consider the vaccines. Vaccines should be coming to market and being tested with humans in about 8 months. Okay. So the question is, to which degree the quarantine efforts are able to limit the delta of new infected people, on one hand, there's nothing to watch. second, to see which is the recovery rate. Recovery rate is people who have gone through the disease or have already been cleared. Today, as I'll show you in a minute, there is more people which have been cleared than people, new cases of people being infected. So the recovery rate is today around 20%, which is quite different. Okay? And third, obviously, when the vaccine is coming to market. If you divide the fatality rate by age brackets, roughly speaking, if you're above 70, your chances of dying are quite high, above 20%. If you are below 70, your chances of dying are very well below 1%. So there is a big distinction as well depending on the age bracket. Here you have the situation in blue on the new cases. Okay, what you can see here is that new cases increased a lot. As I said a week ago, it was because of the change of methodology, 15,000. It was not like for like. Okay? But as you see, we reached the peak of 4,000 new cases early February, came down to 3,000 a week ago, and now we are thinking upon less than 500 a day. So the situation is improving. That's why probably today what we have to fear is fear itself, because fear is what produces economic crisis and recessions, not the clinical data itself. As the other interesting stuff is to look at the green bar, which is the number of cases which have recovered. This is not much in the media, but it's relevant to see that the green bar is above the blue bar for the first week since the crisis started. Here you have also the situation in China, the Delta. Blue line, new cases excluding Hubei has come down. Also new cases in Hubei has come down. I think the Chinese government reported yesterday that the last day only 88 new cases were diagnosed in Hubei, well below the recovery rate. Here, what you have is the fatality rate that is close to, it depends, it's around 3% today, okay, and recovery rate has already exceeded 30%, okay, which tells you that at the end, the final degree of casualties is not going to be as bad as it seems when you hear it. The worrying signal is what you have on your right, which is the new cases outside China, even excluding South Korea or South Korea. In South Korea, it was the main issue. There is already 150 people infected. It seems that this was because of a church, a large church, an evangelical church, where many people convened, and there were some infections in that church, and that's the reason why it spread out very fast. Okay, if you look at the data outside China, which is the dark blue, outside South Korea, is not as bad. We are talking about 100 new cases a day. Here you have the breakdown of the cases outside China. The worst is the cruise ship. Okay, the fact that you have quarantine a cruise ship is a question mark whether it's a good or a bad measure. But should you take all these people and put them into a closed hospital, probably would be a better measure than leaving them on the cruise ship. Excluding the cruise ship, what you have is a situation where probably you have 800 people infected in the rest of the world. 2%, 3% fatality rate tells you that not many people are going to die. The issue is to which degree you are able to impose effective measures on quarantine, such as the ones they are applying in Italy. I just saw that in Spain there is a case, an Italian guy in Tenerife, and 1,000 people have been put into quarantine this morning. New cases, as I said, in Hubei, okay, it's reaching very low, and also in China, ex-Hubei. So it seems that the quarantine measures are beginning to work. And basically, the situation was extremely alarming at the beginning. It's getting better in China. One could think that a similar thing could happen in other countries such as Japan or South Korea. One has to worry upon Iran. In Iran, if you look at the number of dead people compared to the infected people, numbers don't make up any sense. So probably the number of infected people is worse. We'll have to watch Iran as well on the evolution. This graph appeared by The Economist on this Friday, and basically it sees how, if you look at the fatality rate of viruses versus democracies and non-democracies, it's interesting how you tend to do better in democracies than in non-democracies. Sometimes when you have a bad situation, when you don't have a democracy, sometimes you just want to shut people out. They don't want to say that something bad is happening. I don't know if you saw the movie or the show Chernobyl, but the reaction of the Communist Party at the beginning was nothing is wrong, it's okay, and that was the fatal mistake, why then things ended up quite bad. Okay? And I think the situation in China was similar, because the first warning signals appeared 8th, 9th of December. There were medical doctors saying this is a serious new case of SARS, and they were ordered to shut down in the 20th of December. Should they have reacted sooner, probably the situation would not be as bad as it is today. Now, how this situation might be impacting an economy? First, obvious idea, as people are in a quarantine, it's not only a quarantine, and people tell me that if you're in Beijing today, it seems like a ghost city. People don't go out on the streets, hence you don't shop. So the impact is through lower consumption. You should take into account that China used to be 5% of global GDP when the SARS crisis erupted, 2003. Today, China is around 15% of global GDP, and it's around 1/3 of total GDP growth. So they shop less. You don't go often to restaurants, movie theaters. I looked today at data in movie theaters attendance in South Korea is down 58%. Okay, so people don't want to go to the movie theaters, of course. Although in the case of China, 35% of consumption happens with e-commerce. So this is not as bad as an economy such as Spain, where e-commerce is only 5%. So people can still shop through e-commerce. In any case, you have a good example here with car sales down 92% in February. So internal demand, in this case, consumption in China represents close to 42, 43% of GDP. And if consumption goes down, obviously what you're going to have is a negative quarter-over-quarter growth rate. Which means that China probably, if you look at the year-over-year growth rate, think upon the following. December 2018, you have 100 of GDP. Okay. And then at the end of the year, is 6% more, 106. So probably you had 1 or 2 of GDP at the end of first quarter on a base 100 level. So if Chinese growth goes down quarter-over-quarter 3%, this means that the year-over-year growth of China probably is going to fall down from 6 into 1.5. And if it goes down from 6 into 1.5, it means that the impact in global growth is going to be around 70 basis points. So the world, instead of growing 3.2, 3.3, is going to be growing 2.7, 2.6, which is going to be the worst growth rate in many years. Remember also that the IMF defines a global recession in a situation in which GDP grows less than 2.5%. Why 2.5? Because in the past, population used to grow at 2.5%. So what the IMF says is if GDP growth is below 2.5%, this means that GDP per capita could go down. On a global basis, this could be a recession. Today, global population growth is not at 2.5%. It's slightly above 1%. Okay, so it's not that bad if you have a growth of 2.5, 2.6%. But this is going to be the case. First quarter growth is going to come very bad because of China and obviously because of the impact of this situation in other countries. The assumption of the market is that the situation will be contained by March, looking at the deltas I just told you on the new infection cases, and that you should see a V-shaped recovery. The Chinese people will go out to the streets and start consuming whenever the situation has been controlled, and the same in the rest of the world. Yes, but basically we don't know if it's going to be in March, April, or May. Or perhaps it's going to take 2 quarters. In the case of SARS, it took 2 quarters. So this is the big incognita. Which is the impact of this in valuation of a company? Well, you have on one hand full valuations, market will overprice, and they are correcting, as you know. But we're talking about 1 quarter of free cash flow, and you should divide this by a DCF, which looks at an infinite numbers of quarters. So the impact could be at a micro level relevant, especially for companies exposed to tourism and things like that, but at an aggregated level, it's not that relevant should these diseases behave as other ones, such as the SARS and the examples we had before. But there is a few exceptions I will be mentioning in a minute. This is what worries me, yes. Yes, in terms of aggregated data, I would tell you that OECD countries are growing slightly below 1.5%, okay, and emerging markets that are growing above 4%, okay, and the weighted average gives you that. Now the problem is not the short term, the problem is the midterm. What I it worries me a lot is the situation with the Chinese real estate market. As you know, you have evidence to claim that in China you have asset overvaluation in real estate. When house prices are very high, this is a risk for an economy, and it's a huge risk for banks because banks end up financing real estate. And the Chinese banking system has a risk that should real estate prices go down, then non-performing loans go up. And in an economy which is very much dependent on credit, this is very dangerous, okay, because you need credit to keep growing. What happens is that you look at house sales in green, down 90%. Are you going to be buying a house as a Chinese in this environment? No. If situation improves, are you going to go and buy a house, or you just wait? I think you're going to wait. So if there is a lot of supply of housing, if there is not enough demand, you could have a correction in house prices. And this is very dangerous for the banking system, hence for the Chinese economy. And the second derivative is that if you're a real estate developer, your logical reaction is to build less number of houses. So what happens if you build a lower number of houses? You demand less iron, less steel, less copper, etc., etc. And this is how the contagion mechanism impacts other countries. Because then Indonesia will be selling less iron to China, Australia will be serving less zinc to China, and the situation is that if there is a real estate crisis in China, it's going to be impacting the Chinese banking system, but also it's going to be impacting the exporters of commodities. Okay, and this namely is Sub-Saharan Africa, some South Asian countries, and some in Latin American countries. And this worries me, because some of these emerging markets have too much debt. And when you have too much debt, the last thing you want is lower growth. If you look at Chinese developers, here what you have is the funding source of Chinese developers. Okay, and basically they issue bonds in the US at 9–10% yield, but the green line is pre-sales. So you give me your money, and I promise you I will be giving you a house in 2 years. Now what happens if at any point these companies cannot keep funding their bonds? And I think there is $100 billion of developers bonds maturing this year. Basically, it means that you don't have enough working capital to end the construction on houses. So you have a risk that some of these houses will not be rendered. And if that happens, obviously, this is a big threat for the stability of the system, because people will get very angry. And if they stop having trust in the financing of pre-sales, what happens is that you stop giving your money as a pre-sale, and this self-reinforces the problem with developers. This is more or less what happened in Spain in 2007. Here you have the situation in the case of Hong Kong, what happened with the retail sales with the SARS. You see a sharp decrease of retail sales, so they came down 15%. And then in a question of 2 quarters, situation was above what you had before. Obviously, when retail sales come down, you save more money and then you spend it afterwards. Okay, so this is the base case for the market, that this should be happening. The main problem is that we don't know how much time we need for the whole thing to be contained, one quarter or 2 quarters. So how is the spread out mechanism to other economies? We already have the first February data, activity data. So we had the first flash PMIs. They appeared yesterday in the States. So there has been a 4 points decrease of the flash PMI. This is the green line. So what this tells you that perhaps Q1 GDP of the US comes quicker than expected. I recall that the US economy was growing at around 2%. Okay? Hence, if these PMIs of February keep on through March, perhaps we're going to have a weaker growth in the US, perhaps 1.5. Okay? This is not only a consequence of less Chinese tourism into the US. I also can give you one data. The Chinese spend $280 billion every year in tourism. So if you receive Chinese tourism, such as Japan, the Philippines, Vietnam, you have an issue. Okay? But I think also here what you have is some fear upon the possibility that Bernie Sanders wins the Democrat nomination in March. Okay? In any case, you begin to see some weakness in the US economy. It's nothing to worry about. There is not a recession coming in the US at all, but probably growth is going to be weaker. The interesting stuff is Europe. You know, Europe has more exposure to China than the US because Europe exports twice as much as the US as a percentage of GDP. However, the PMIs we had of February show that they have increased 1 point. From 51 went up to 52, which points towards a slightly higher activity of GDP growth in the first quarter. So in a sense, it's interesting to see this relative positive performance of the European economy versus the US economy. Should this trend continue, then what I would envisage is a weakness of the US dollar versus the euro, because the US dollar is very strong. It's too expensive, okay, because people took refuge in the US dollar. Okay, but what happens once you begin to see a weaker economy in the US? The Fed will have to react. If you look at futures, the market is discounting that the Fed might be cutting rates once or two times this year. So if the Fed decreases rates two times, which is 50 basis points, and the Europeans don't do anything, or perhaps they move down rates 10 basis points, the difference in yield between the US assets, US bonds, and European bonds just goes down. And this produces an incentive for people to sell asset portfolios and enter into dollar portfolios and enter into euro portfolios. Okay, so this is a midterm thing I think might be happening. This is the stocking, yes. The Americans, they don't import anything. The American imports is around 13, 14% of its GDP, which is nothing, to be honest. It's not an economy where imports have a huge size. In the case of Spanish, probably imports is 33, 34% of GDP. It's a closed economy, the US in a sense. Okay, what you have is a microeconomic impact in the supply chains, which is the other midterm thing I am worried about, and this is not going to disappear in one quarter. So you have built a world, a Bretton Woods 2 world, in which you would be outsourcing your manufacturing activity into China. If you're Apple, you use Foxconn. Okay, and they produce high-quality goods with a limited cost, and then you ship it to the US or whatever. Now, on this model was questioned already before the crisis started. Why? Because salaries in China have been growing at 10, 11%, productivity at 6, 7%. So you lose 6 points of competitiveness every year. On the other hand, you have uncertainty over tariffs. In the past, it was okay, and now I have no clue where tariffs are going to be. So what you begin to see is how some companies started to close down some activity in China and send it over to places such as Laos or Vietnam. Okay. Second, you started to see how people began to send back factories into the maquiladoras north of Monterrey, because at the end, the Mexican salaries did not increase as much as the Chinese ones. So the maquiladora industry, which was destroyed by the Chinese growth, is beginning to reborn. And finally, you are also beginning to take back your factories into the US or Germany. Why? Because the cost of labor is much higher, but the productivity is also very high. You don't have a transport cost, and you don't have a tariff uncertainty. Finally, you have a structural phenomenon driven by the Internet of Things and driven by printing, 3D printing, is that today, if you look at Adidas, the two new factories they opened 2 years ago, one is in the US, one in Germany. They don't have workers, just print the sneakers. Okay? So my worry is that this acts as a catalyst, this virus, first, as a Minsky moment that would be impacting on real estate. Second, as a Minsky moment that would accelerate this insourcing. And this could be a threat also for the Chinese model going forward. In the meantime, if you look at the level of inventories we have now, it's the lowest in 8 years. So companies are using inventories to be able to cope with production. Okay, the problem, of course, is to which degree China is going to be able to go back into production before the stocks are over. In the short term, of course, this might produce a rebound of inventories because you need to restock as well, which is positive for the economy. And also think that the sharp decrease in the oil price, 15%, moves down gas prices, so this increases consumer confidence. So this might increase retail sales, especially in the US. How is the production doing? Here you have a situation of steel inventory. If you are back into production, then the steel inventory goes down because you just convert it into elevators or whatever. As you see, the latest data by the mid of February, this is Macquarie, you see that the steel inventory is not coming down after the Lunar New Year, but it's still very high, which tells you that the economy is not back into production at all. We still don't know the degree, okay, but if you look at the number of miles being traveled, when you look at number of inventory, you look at coal emissions, the situation is serious. That's why no one has a clue. But the rule of thumb could be that you have this decrease of economic growth quarter over quarter of around 3%, which would decrease the year-over-year growth from 6 into 1. This is much worse than what you have today in numbers. I think Deutsche Bank was expecting first quarter GDP growth of China 4.6. And what I'm telling you is that probably is going to be closer to 1.5. Yes. If gas prices go down, you have more money to spend in beers. So more consumer confidence and more retail sales. Some countries benefit when the oil price is low. Turkey is a good example. Spain is another one. I was telling you that the contagion effect is that I build less houses, so I build less elevators, so I demand less steel, and I demand less copper. Copper is the most sensitive industrial metal to trade. China makes 1/3 of total imports of the world, 35%, and more than 2/3 the exports of many African countries. Look at the copper demand. So if copper demand is weak, then obviously this tells you a good way of how you begin to see the contagion effect. Another data I brought you here is the evolution of air trips in Australian airports. What you can see there is that Australian airports traffic has come down aggressively, and it's not coming back up, okay, which is obviously an issue, okay, and tells you how the number of Chinese tourists are coming down, and this has an impact immediately on the $280 billion that the Chinese spend overseas every year, which, by the way, this would be good for Chinese GDP, because every dollar you spend outside your country, this goes as a negative in your GDP. And each dollar that the rest of the people spend in your country is positive. In the case of China, the net balance of tourism is quite negative for China. So the fact that less Chinese people travel outside is not bad for Chinese growth, is good. Sensitivities of different countries to 1 point less of Chinese GDP growth. Many times what you see is fear. When you see fear, you have to put numbers into fear, okay? So if you have a lot of exposure into China because you sell a lot of goods into China, South Korea, you see the relationship is 1 to 3. 1 point of less growth of China implies 0.3 in the case of South Korea. The closer you are to China, the more exposure. As you can see, Hong Kong, Thailand, Malaysia, as well as Japan. Look at Spain, for instance, the impact is 0.02. So if China, the Chinese, and this is assuming the whole year. Okay. In the case of Germany, they have more exposure than Spain, but the impact is minus 0.12. The risk, obviously, is that if Chinese growth goes from 6 into 2, if it's 4 points less would make probably an impact in Chinese or in German first quarter of 0.7, 0.8, and perhaps you have a negative growth in Germany that if it goes on into the second quarter, you can produce a recession, technical recession. In the case of Italy, they already had a negative growth in the fourth quarter, minus 0.3. So if you look at Italy here, I don't know if I have it here. Yes, Italy is around 0.05. So probably Italy, just because of the Chinese effect, is going to have minus 0.2. So Italy could go into a recession. And obviously the impact in Chinese, in tourism into Italy. Italy receives more or less 40 billion euros every year for international tourists, and this has an impact. And you have closed already University of Milan and schools, etc., etc. In the case of Turkey, the correlation is positive because of dependence of oil materials of Turkey. So if Chinese growth is lower, then the price of oil goes down, and this is positive for Turkey. The other consideration, of course, is supply chain. Yes? Sure.
In the case of Turkey, because of the oil prices, it has like a negative correlation with China. So yeah, in the case of India, it's 0%. Like there's no impact on India because of Chinese slowdown. India is also a huge oil importer. So why it's not a positive?
Probably because you need to balance two things. On one hand is the positive effect of lower oil price. Second, the negative effect of your exports into China. So India is closer to China than Turkey. So probably the exposure that India has into the Chinese GDP is higher than that of Turkey. Now, this is which percentage of parts and components on the electronics industry is imported into China. This is a way for you to understand which is the supply chain dependence of an industry into China. So in the case of Japan, if you look at this sector, more than 40% of components are made in China or processed in China. Okay, at an average on at the world level is 30%. So this is a supply chain problem that obviously has a negative impact in the short term and a questionable impact in the midterm because people perhaps think upon setting up manufacturing abilities in other places. And to the right, you have the same data, but looking at machinery and transport equipment imports from China. So overall, this is what Deutsche Bank was estimating a week ago. They said that the Chinese quarter-over-quarter growth could be minus 1.2% quarter-over-quarter. So the global impact that they were expecting, including also the impact in Japan and other Asia, was around 30-40 basis points. I tend to think that the impact of China is going to be well above 1.5. I would go for twice as much. I think that we might be seeing quarter-over-quarter growth of minus 3%. Then would lower total growth of China year over year from 6 down to 1.5%. Okay. And if you add up this to the impact in Japan, South Korea, perhaps you see a total impact in total growth of closer to 90 basis points, which means that the world, instead of growing 2.2, 2.3, might be growing 2.6, 2.5, which would be a risky level of growth. Okay. But obviously, when you care in evaluation is long term. So this is going to be 1 quarter. The key issue is whether this is going to be impacting the second quarter or not. And obviously, the impact of this in analyst recommendations and analyst estimates of profit growth, which drives. The problem was not itself the impact in evaluation, but the fact that markets were fully priced. Other things to watch aside the coronavirus. On one hand, what I think is relevant is to look at which is going to be the impact on total growth, which, as I said, is probably going to be around 0.8%. Okay, and the second thing to watch is which is going to be the response of monetary policy and fiscal policy. So the Chinese government has already announced that they will be announcing fiscal stimulus. The Chinese government already has a deficit of 6 points of GDP, but they can't afford going into 8 because the debt of the government is limited, and they could be cutting down taxes or spending more money. The People's Bank of China has already lowered interest rates 10 basis points, and they can go for more. They have injected $300 billion in the banking system. The question is to which degree the banks are going to be lending this money into the SMEs, or they just will go for the safe thing, which is to lend it to the state-owned companies. The problem not to watch is small companies in China, because they are very much needed out of liquidity, and they are a relevant part of the employment in the country. And by the banking sector have a bias towards state-owned companies. The Fed might be cutting rates, as you know, and perhaps they extend the purchase of bills, which was going to be ending in March. And the ECB, they could be lowering rates another 10 basis points, from minus 15 to minus 60, and perhaps they go for a QE instead of 20 billion, they go to 30 billion. Those are the potential answers to this situation. And finally, perhaps the German government announces some fiscal stimulus. Okay. The problem when you see these reactions is not the reactions themselves, but the demand. So if the Chinese central bank lowers interest rates 10 basis points, is this going to propel a Chinese guy to buy a house? It's lack of demand. It's not the supply, it's the demand. The problem when you have this situation. In the case of Spain, interest rates went down to 0. And you know, new house sales went down 95%. When people are scared, they just are not sensitive to interest rates. I'm going to also be letting you know a few thoughts on ESG, which is very fashionable today, and some thoughts also on demographics. I was telling you that at the end, if you want to understand growth in an economy, it's about understanding demographics as well as productivity. Productivity more or less is stable, it's mediocre, around 1% in the case of OECD countries, 3% in the case of emerging markets. But look at the situation of live births per woman. Okay, but basically what you have is 1.6 in OECD countries, with some exceptions. In the case of China, in the case of Spain and Italy is 1.3. In the case of China, which is no OECD, but China is at 1. So China abolished the one-child policy 5 years ago, and 5 years afterwards, they still have 1. Okay, number of births is coming down 20%. The world growth rate today is around 2.2, 2.3. So it's getting very, very close to 2.1. If we go below 2.1, it means that for the first time ever, you will begin to see population decreases, probably starting in 2030, something like that. Okay? And then you have other emerging markets such as India or Brazil, that in a few years have come down from 6 into 2.5. Brazil is below 2, used to be at 6. That's the reason why they have a big problem with the pension problems, because you design a pension system when you have 6, but if in 30 years this goes down to 1.5, it just doesn't work. Okay, and that's why the pensions have to be rethought in this kind of environment. This data supports the thesis that basically we have to go into a low growth going forward. Okay, because if productivity is subdued and the growth rate of population is very limited, it's around 1%, this means that we're going to be seeing a very, very mediocre growth rate in the world, which means that the interest rates are going to be low as well. Also, I wanted to touch your attention upon the relevance of real estate in finance, as well as in the global economy. As you know, the total amount of GDP in the world stands at $90 trillion, 90. So the amount of assets you have in houses is around 160 trillion. That's why it is so relevant to understand housing, because if house prices go up, people consume more and vice versa. Look, compare this with the value of total stock market, the equities. It's around 65, 70 trillion. So housing is twice as relevant for the wealth of families than equities. What happens with house prices is that more or less on real terms, net of inflation, they were stable and they began to go up aggressively in the 60s. And it makes sense. Whenever interest rates go down, then house prices go up more than your income. Okay, and this process has become even worse once you introduce QE. Once you introduce QE, you no longer want to save in bonds, you go into housing. Okay. Now, as I was telling you, QE was a necessary tool to put the world back to growth and to reduce the unemployment rate. That was the right measure. The consequence is that house prices have gone up a lot, and today you have a generation of young people that will never be able to own a house. Okay, and that's why we need to think upon housing policies that favor young people, because otherwise you have an issue. And some academics say that the fact that young people cannot buy houses, access to a house, also is linked to the decrease in the birth rate that we are seeing. Well, basically, you have different factors behind the birth rate. One is how many years women received education. So the higher the number of years, the lower the number of births. Okay, and in a good way, women have gone from having a limited number of years of education to much higher, including college. So this reduces your birth rate. Second is driven by urbanization. If you live in a small town, you can have 4 or 5 children, it's fine, it's easy. If you live in rural areas, in a big city where you have to commute 2 hours, it's very tough. So the fact that we keep sending people to live in large cities is a negative factor behind birth rates. Third, to have children, you need a fixed contract. And many people, when they are young, they keep getting temporary jobs, and it's very tough to take a decision to have children with temporary jobs. And once you have a fixed job, it's too old. You are too old to have children. And finally, you want to have the security and the safety, which means that you own a house. Okay, the 4 factors to have an impact. Obviously, you can discuss with academics the relevance of one of each of the 4. So the situation today is that the number of houses we built per 1,000 people used to be at around 6, 8. Once you had population growth, now it's around 4. So the market has come down 50%, okay, because of lack of young people. Normally, it's people above 35 is people who really buy aggressively houses. And you have the same data here in the case of different countries in Europe. Very low rates today. Thinking upon monetary policy, the first idea is look at the balance sheet of central banks. Okay. More or less, if you add up the balance sheet of the Fed, the ECB, the People's Bank of China, the Bank of Japan, Bank of Finland, and the Swiss National Bank, they had $3.5 trillion. Today they have 20 trillion. You should put this graph, of course, as a percentage of GDP, but probably this was close to 5% before the crisis, and today we're close to 20%. So we have today a huge level of balance sheets of central banks. $20 trillion, you should divide it by 90, which is the total amount of GDP. And take into account that basically these guys have created almost $20 trillion of money, in a sense, which obviously this explains why you have weird asset prices. Why do you have the Greek 10-year bond at below 1%? That's weird. A country that has defaulted 3 years ago is because of this. Okay, or Spain raises finance at 0.3% in markets, the US at 1.4%. And I tell you, Spain is a riskier country than the US. So it's a question of monetary policy. This was necessary action. Again, many people have benefited because they have found a job. The bad thing is that this creates a lot of financial instability, and we need to live upon this risk. The second theory today, yes? Yeah, you ask if central banks can reduce the balance sheet. It has already happened. It's called QT, quantitative tightening. The Fed has reduced the balance sheet at a pace of $350 billion a year once they announced the start of QT. But as you know, they began to move down the balance sheet. So this was against excess reserves in the banking system. And as you know, in September, the overnight interest rates went up to 8% because lack of enough reserves in the bank. So the Fed had to change the policy, and they began to add reserves again since September. So do I see a scenario in which central banks will start reducing the balance sheet in the next years? No. Only if inflation appears. If inflation appears, then we have a big problem, because then they have to raise rates or they have to reduce the balance sheet, which means that asset prices would just collapse. But for inflation to come, you need more demand, less supply, and salaries to go up aggressively, which up to now we don't have evidence that is happening. Do we have the risk of inflation? A lot. Do we have the reality? Up to now, no. This is the only break you have to that.
Does you see inflation as a potential consequence of disruption in supply chain?
No, because in general, when you have this situation with viruses, you have lower demand, okay, and you have the same installed capacity in terms of supply. So the natural tendency is to lower prices, not to increase prices. The problem is that central banks are no longer successful in impacting the economy as in the past. Okay, why? You have one explanation here. In the past, you tended to have a lot of cars, housing, industry. These three things are really sensitive to interest rates. Today, you have a lot of sectors that are not going to a restaurant, buying food. This is not that relevant for interest rates. So the economy has changed a lot since then, and the fact that today plenty of sectors are no longer sensitive to interest rates limits the ability of central banks to influence the real economy. Okay, this is something for us to consider. Even the capex. In the past, you used to do capex. I'm going to be building this machinery, and I'm going to depreciate it in 20 years. Now you invest in a piece of software that you amortize in 4 years. So it's not that relevant interest rate. And of course, once you enter into QE, what happens is that, yes, you create more demand, but you create more inequality of wealth, of course, because interest rates go down, equities go up, house prices go up, so old people get a benefit versus young people, etc., etc. Also, financial instability tells you that when you have interest rates that are very low, very, very low, bad companies survive. These are called the zombie companies. Those which EBIT is close to the financial expenditures. These companies should disappear for new companies which are creative to take over. But when you have this situation, then you can create zombie companies. Zombie companies do not invest, okay, and they create more deflation. Okay, this was the situation in Japan in the 90s or in Italy today. So you have also a negative impact in your productivity, because you want bad companies to disappear so that productivity goes up, and this can create more growth. And in this environment, obviously, you also create populism, because people see they cannot afford buying houses, and this is also a recipe for populism. In Hong Kong, they tell me that part of the problem of the situation in Hong Kong is not only political, it's the fact that people realize they will never be able to buy a house. Here you have the populist vote in Europe as a percentage. So in 1980, you tended to have 15%. But look at the breakdown. Almost everything was left-wing populism. Today, what you have is 25% of support of populist parties, but almost more than 2/3 is right-wing populism, okay? Which is something to consider. I'm not saying that monetary policy is the only guy to blame for this situation. It's also the fourth industrial revolution, but obviously this is a world which is politically quite dangerous. So the answer could be, if we have more productivity growth, we can be paying our debts. We could be having a lot of growth. The problem is that productivity, as you can see there, once the crisis started, has not followed its trend. It's been weaker, very weak. And obviously this is bad for growth, it's bad for your salary, it's bad for incomes, it's bad for everyone. Part of the problem might be the fact that these zombie firms keep existing. Okay, the fact that QE has this unintended consequence of letting some supply to be on the ground when it should disappear. Here you have the evolution of labor productivity. Advanced economies, the US is growing around 1%. The productivity growth in Europe is less than 0.5. And what you have is a mediocre productivity growth. It's very hard, by the way, increase your productivity once you have a very high starting base. The US has $60,000. Germany is 40,000. In developing economies, it's growing less than 4%, which is okay because the starting base is very low. China has $10,000 of per capita GDP, so it's easier to grow the productivity. But also, it's worrisome to see that these guys were increasing their productivity at close to 6%, and it's not coming below 4%. So this is a global phenomenon today. So getting into ESG, main messages. I think I told you the last update that this is coming. This is not a fashion, so we should learn a lot about that. It's relevant. Now, we should distinguish the E from the E, S from the G. We can discuss a few ideas on the three. I will also advise you to consider including a fourth letter here, which is D of democracies. In general, democracies explain better level of happiness in citizens and better level of GDP per capita. I think there is a new paper written by Acemoglu. You know Acemoglu, the guy who wrote the book Why Nations Fail. He's Armenian. And basically he shows that whenever a dictatorship becomes a democracy, what you see is a boost of GDP per capita of around 20%. And sometimes it's funny that you see investors very much worried on ESG, and then they buy bonds of nasty dictatorships, which is a little bit hypocritical, but this is the reality. Now, first, why this is here to stay? Basically because there is a lot of new money being raised as ESG. So if you have a venture capital, private equity, equity fund, fixed income fund, if you label it as ESG, you're going to get more money than if you don't. That's the reality. All the pension funds have mandates to invest in ESG, so people just accommodate to this, and I don't think this is gonna change. So there is already more than $130 billion in ESG strategies. This is just the US, and every year 20 new billion are being raised, and this is exponential growth. In terms of the E, at the end, if you look at the breakdown on the way we produce energy, what happens is that yes, renewables share will go up. We had data that last year, for the first time, the level of CO2 issued by the energy sector didn't increase for the first time ever, which is good news. The problem is that as still the population growth is going to keep going up, there is no way to achieve the targets we have thought, the scientists have thought as necessary to limit the problem. So the only way to solve the problem is basically by carbon storage and carbon sequestration, being able to go into the atmosphere and make carbon to disappear. Only through renewables, this is not going to be the solution because it's not fast enough. Okay, so what some academics say is that, look, probably in the past, the big polluters were the energy companies, utility companies, automobile companies. Are they innovative industries with the ability to have innovative solutions to go into the atmosphere and make CO2 disappear? The answer is no. It's very, very hard to say. And what some people say is, look, the two most innovative industries are technology and pharmaceuticals. Why don't you create a carbon pricing scheme so that you give them a big price in case they are able to find these technologies, and to rely on the ability of human beings to develop these ideas to be able to solve the problem through carbon elimination in the system. Here you have the breakdown of CO2 emissions between the US, China, and other emerging markets, and other OECD countries. So today, more or less, you could say that 1/3 of emissions are done by OECD countries, 65 by emerging markets. And of course, what emerging markets say is, look, I'm now having a development phase, and I need to raise my energy production to be able to satisfy the fact that 40 million people are entering into the middle class every year, as you did in the 19th century. So what you cannot tell me now is that now I have to go to zero. If you had this positive impact of development in the 19th century, it's fair. But as long as we are in this situation, That's why I was telling you it's not that easy just to solve the problem by replacing all the existing flow of energy towards renewables, and we have to go for something else, and this implies being able to storage the CO2 or to eliminate the existing one. Here you have the evolution of CO2 in blue, okay, and the per capita in pink. And you can see the problem here. It's not the per capita, which obviously has gone up, but based on number of people. We used to be, as I told you last time, 4.5 billion people living in the world in 1980. Now we are 7.7 billion. So there is 3 billion more people in just 4 years. If you take into account the per capita CO2, 3 more billion people, this makes the blue line to go up. And this thing is not going to change in the next 10 years. Impact on different industries. This is the oil consumption, million barrels per day, around 100 million. Okay. If you want to incorporate the agreements and the ideas discussed in the Paris Agreement, probably this will be capped. And for the first time, the oil consumption will not go up above 110. But basically, if you want to solve the problem, this has to go down to 60. And this is not going to happen. It's not going to happen. That's why we need to find innovative ways. One positive hope is the renewable cost has gone up aggressively, especially solar. So solar was very expensive, $350 the megawatt hour, and it's come down today at levels around 50. So today you begin to claim that solar, if you keep having these economies of scale, solar can replace existing assets of producing energy, for instance, with coal. Here you have the case of India, which obviously is one of the places where you have more increase on the middle class. And what you can see in the case of India is that the cheapest fossil fuel costs you, let's say, $65 the megawatt hour, and today in India you have solar cheaper than other alternative sources of energy. Okay. Obviously, in other places where you have a cap, you need to subsidize solar so that people have an incentive to replace coal with solar. But the question is not where solar stands today, but where solar will go if we keep reducing the cost of producing it. And what I was saying is that at the end, CO2 goes up because of population growth, and it goes up because of GDP growth. Okay, and even if GDP growth is mediocre, this means that, and even if you reduce the intensity of CO2 into the GDP, it's going to keep going up, the pink line. Okay, so basically you need a huge recession of 12 points of decrease of GDP for this thing to go down to zero. And as this is not going to happen because people don't want a recession, we need to find innovative ways. That's the only way. Okay? And many times you see interesting stuff. Some countries are very green, such as the Nordics, but where you have the problem is not in the Nordics. Where you have the problem is in places such as Bangladesh or people in Siberia that need to leave because your places are melting. Some people are also green in Germany, and then when you want to install a windmill, they don't want because it is against the country shape, the landscape. So many times it's not that easy to implement policies at a practical level. Here, what you have is the inequality thing. I think ESG today is about two things: the environment first, and second is about inclusive growth. Okay? I think those are the two key ideas behind ESG. And as you know, what you have is that clearly there is a lot of wage dispersion happening in the world since the fourth industrial revolution. I've been giving you a lot of data in the most recent updates. This is going on, even between people with the same education in college. If you studied philosophy or mathematics in the past, difference was not going to be great. Today is great. The same happens of difference of people with higher school and with college with a postgraduate. And again, it's a question that the market is moving towards a need of skills, and we have not been able, from an educational point of view, to supply with the skills that you are demanding in the labor market. This creates huge dispersion of salaries. You also have more wealth inequality, and this produces unrest. Okay, so what we have to think here is how we can answer to the world and solving it with practical problems, solutions. Sorry. So in my opinion, the solution is not to confiscate the wealth or to put the marginal taxes at 99%. The only solution is through education, being able to provide the educational skills that the market demands. And in my opinion, it's not about setting up more universities or colleges. It's about lifelong education. How can you retrain truck drivers? Okay. And I think this is the thing for us to think. Once we run companies, how do we are able to serve our workers, providing them with lifelong learning tools that would give them the ability to face the fourth industrial revolution. The situation with the D of democracy, what you see is, yes, there is more people living in democracies versus non-democracies or hybrids. The problem is that many people who live in democracies assess the quality of democracy as going down. In general, in Europe and Japan, as well as in the US, people complain upon democracy more and more. Okay, part of the reason is the situation with inequalities. Part of the reason is the situation that once you see asset prices that are unaffordable, people complain. And I think part of the reason is right, is that democracies are made to support and to defend the weakest link in the society. Okay, and today what democracies are doing is just supporting the strongest link in the society. So pensioners over young people, fixed contracts versus part-time workers. And this creates a puzzle, it's an inconsistency. Basically people who are weak, because they don't have enough number of votes, they get punished in a democratic system, and we have to think upon finding solutions to this. A few ideas on finance. What's going on recent events in finance? The first thing is that if you work in finance and in asset management, one thing for you to consider is basically going for permanent capital. Blackstone and Apollo, they presented results, and basically what they say is, look, I'm raising my permanent capital. So if you raise a private equity fund, probably it's going to last 5 years, and then you have to keep on the road again and again to raise new funds. Okay, permanent capital allows you to have evergreen money. Okay? In the case of Apollo, they've done it with Athena, an insurance company. They bought it and they have a management contract with Athena. In the case of Blackstone, they have launched some perpetual funds to invest in real estate. Think upon this, because I think the industry is going towards this direction. If you look at the traditional asset management industry, you are seeing plenty of M&A deals happening. I don't know if you saw Franklin Templeton acquiring Legg Mason, $6 billion, huge deal. Why? They are concentrating, basically because passive strategies are winning. So as passive strategies capture a market share, then you see a compression in your commissions. It's no longer easy to charge 1.5%, 1.3% commissions. So you need to find economies of scale, and economies of scale means having this M&A and then also securing alternative data. Okay, and this trend is going to continue. Yes. No, permanent capital is equity, is not debt. Okay, so you could raise a vehicle in the market which is listed. Basically, the money is there, and you invest it in VC or whatever. Okay, the problem, of course, is that if you have the vehicle has $300 million and you have put $5 million, it's not that easy to exit your investment. So basically, it's not a closed-end fund in which I promise to liquidate the fund and give it back to you. It's an evergreen. Okay, so the problem is with liquidity in the secondary market. In terms of London and the city, this is the estimate. This is Pantheon Economics, but also it's basically the UK Treasury Estimate. They basically believe that the Johnson's deal will have a negative impact of more or less 7 points in UK GDP going forward. Okay, and the main industry impacted here is going to be, in my opinion, finance and services, because the EU has already said that they don't want to provide London with a passport, of course, and neither with a permanent equivalence. A permanent equivalence would allow London to keep trading services with Europe, okay, on a permanent basis. Today, you could have an equivalence agreement such as Hong Kong with Europe, but you could change it in just 15 days notice. And obviously, you're not gonna stay with your bankers in London. You have the risk of someone canceling this in 15 days. And that's why they want a permanent one, and Europe has said they are not going to grant it. So what I would be expecting in the coming months is to see more announcements of people relocating from London into other places. According to Oliver and Wayman, there is 40,000 jobs at risk here. Okay. HSBC, as you know, has already announced 35,000 people are going to go in investment banking and private banking, namely in London and also in the US. And I think this is a first step. This is the evolution in which everything is expensive, forces you as a rich guy or as a pension fund to invest in private capital, private debt and private equity and venture capital, okay, infrastructure, these kind of things. So these guys used to have, in the year 2006, less than $2 trillion. Today they have $6.5 trillion, and this trend is going to keep on. Okay, I would say that on average today you have an allocation into private capital between 18 to 22% in major institutions. At the end, these things, if you look at the illiquidity premium you get by investing in private debt today, you get 3.5% illiquidity premium, 4%. So why on earth are you going to be investing in 2% double B bonds if you can get 6% in similar risk in the non-listed market? Okay, so this trend is going to keep on. And for you guys, I think it's an interesting chart because this forces you to think upon your career, moving in the buy side into this industry or in the sell side to guys who work with this industry. So if you work in the financial sponsors team in an investment bank, the team is going to keep growing. If you work in equity capital markets, no, because there is not many IPOs left. A few thoughts on the US. Well, basically, the U.S. economy ended up the year working or growing at a nice way, at a nice rhythm. The thing is that you have some financial instability in the U.S. Okay. Why? Because there is too much debt. There is too much debt. As you can see, the debt of non-financial corporates has increased more or less 10 points as a percentage of GDP. Okay. And the problem is that there is too much bonds which are triple B, too many. So if there is a slowdown of the U.S. economy and a few of these bonds become double B, this is called in finance fallen angels. Hence, the ketchup, it has become a fallen angel last week. And what the problem here is that you have a market of more or less $1 trillion in high yield, $1 trillion in leverage loans, which is also high yield, double Bs, and triple Cs and Bs. And the investment grade market is around $5 trillion. So what happens if 1 out of the 5 becomes fallen angel? There is not enough money. So this is one of the risks I see in the U.S. economy. Okay, lack of liquidity in the secondary market and too much debt in investment grade. Of course, much of this money has been used to buy stock, which is not the best way of uses in terms of financial stability. What I have noticed the last 2 weeks is a sharp decrease in the job openings in the U.S. These are number of jobs that basically don't get a worker. For the first time ever, I saw in the US more job openings than unemployed people. I think we had 7 million job openings, 6 million unemployed. This tells you that it's a very tight job market. This is beginning to change. You are beginning to see how companies are not as aggressive in recruiting people. Should we worry that a serious slowdown is coming? No. The main predictor of a change on the US economy is the initial jobless claims. Every Thursday at 2 o'clock Spanish time, you have initial jobless claims. How many people have been fired and went to ask for protection for the Social Security? Okay. On average, historic average is probably 260, 270. We are at 200 now. As long as we see this indicator at this level, it's fine. And this probably will mean that Trump will win the elections should the Democrats choose Sanders. Okay, because in that case, I think the most moderate members of the Democratic Party will end up not supporting Sanders. And as long as the economy keeps doing well, then normally the incumbent president keeps re-elected. Should initial jobless claims go up aggressively in the following months, then Sanders has a choice, or some chance. Okay, here what you have is the evolution of the 4th quartile of US workers, the ones which make the less. Okay, so on average, you are seeing salary increases of 3%. If you are a low wage earner, you are getting 4.5%. So today's waiters, construction guys, all these who are getting the best in terms of wage increases. Another reason why I believe that this is a bad economic outlook for Sanders to win. This is the latest polls. So the futures were giving you less than 50% of Trump getting re-elected in January, has jumped to 55. Why? Basically because the market was thinking if Joe Biden is elected as candidate, he's a moderate, he has a chance of beating Trump. And that's why the futures were giving less than 50% chance of Trump getting re-elected. Today, as it seems that the market is pricing that Sanders is going to win, the chances of Trump winning go up 10 points. A few thoughts on China. I already mentioned the main ideas behind China, but look at this graph, which just tells you what's going on. Basically, this is the level of assets in the Chinese banking system since 2008. So I think today you have more or less $60 trillion in the Chinese banking system. This was 15 in 2008. So this is an economy thirsty of credit. Okay, and this is very dangerous. When you see sharp increases in the level of banking credit, this also tells you have asset bubbles. Okay, and this tells you that this is an economy thirsty of credit. If you have a problem in a banking industry like this, you have a big problem with the economy. Remember always the metaphor about the blood being pumped to the central bank, which is the heart, we are the muscles, and the banking system brings the blood to us. If the banking system stops working properly because you doubt upon the solvency of the liquidity of the banking system, you have a big problem with the muscles. Here you have the demographic situation. More or less, you stabilize the population with two, in this case 21, is 2.1 per woman. We are at 1. So China is already having negative decreases in population, in active population. So when you have negative increases in active population, unless you grow a lot, your productivity is very tough to keep growing very high. At the end, it's the math which tells you how much you're going to grow. It's not Trump or the Communist Party or whatever. It's math, which is demographics and productivity, those 2 points. Here, the situation with population growth. Okay, this is total population growth, but active population is already in the negative territory. And what drives GDP is active population. Probably India will become the first, the most populated country in a few years. It will surpass China soon. And here you have the changes on how working age population is evolving, okay, which is obviously worrisome. In Europe, a few thoughts. First, if you look at the support of the euro, this is the Eurobarometer, it's a record high, it's 76%. Tells you something here. Populist parties are not going to raise the anti-euro banner in the elections. Okay, if you look at this graph in France, it's similar, and Le Pen has to stop saying bad things upon the euro. When you blame the euro for something, then populists, but as soon as they see that voters support the euro, they stop saying it. Or you could get elected, such as Syriza in Greece. I want to be on the euro, but I don't want to comply with the fiscal pact. And this is the problem, that you basically have a solution which you cannot comply with. I want to be in the swimming pool, but I don't want to pay for the fee of the swimming pool.
Why would you say that? I mean, how do you explain this change? Because we've seen like Brexit, we've seen Le Pen gaining traction like 4 years ago. Did something change, or they never were able to capture deglobalization or protectionist
Well, I think one thing has nothing to do with the other. On one hand, the origin of the euro as an idea in the 50s, it was because, when you share a currency, it's very tough that you fight a war. The origin of Europe is about not fighting wars between each other, okay, which is normally true. So it's a way to achieve political union, not only economic union. Second, once you have these guys against the euro, or wanting to be in the euro but against European institutions, getting into the power, such as Syriza in Greece, Salvini in Italy, the beginning of the Portuguese government, what you see is that who basically was worse off was humble people, because interest rates go up, you need to pay more to your creditor, which is the ECB, and then you have to cut down pensions and things, and then people say something is wrong here. And these magical solutions that they arrive to power, and I'm going to remain for the euro, but I will do whatever I want, people have seen they just don't work. In the meantime, what you see is that the euro works very well for Germany, because it allows Germany to export 47% of GDP. No way they would have it should they have the Deutsche Mark. Then the Germans have a lot of money invested in the Spanish mortgages, a lot, 200 billion. So what happens if the euro disappears? Many pensioners would lose their money in Germany. And if you look at the hard data, is that basically all the members of the Eurozone today enjoy better real incomes on a per capita basis than before the euro was introduced. So I think once you put the noise out, people realize that the euro is good for everyone. You see that in the worst of the years, in the middle of the crisis, 62% of Europeans supported the euro, 62, which is a lot. Impact of Asia, as you see in the case of Germany, 3 points of exposure as a percentage of GDP. China is 7% of German exports. Spain is much lower. Okay, so Germany is going to have a problem. They already suffered last year, but they're going to keep suffering. My fear is that probably Spain has some of the goods we are selling into Germany end up in China. They are reprocessed in Germany and they end up in China. Okay. In any case, the impact for Europe of a slowdown in China is not going to be as bad as the impact you will see in Japan and South Korea. UK, this is the situation with investment. Investment is the leading indicator with an economy. If you invest in a new office, you hire people. Okay, look at investments since 2006, more or less they went up 10 points, between 10 to 13 in other economies. In the case of the UK, it has remained flat. So business people, because of uncertainty, they don't invest. And if they invest, this is telling you as a leading indicator that something will not be good coming in the UK economy going forward. And a few thoughts on the rest of the world. Sorry, before I go into markets, the rest of the world, what I would say is focus your attention in Turkey. The credit default swap is getting worse and worse. Weakness of the lira. Erdogan has announced some measures to avoid people shorting the lira. But you know, you short the lira because you lend your loan as a bank. You give a loan to someone in liras. You fund yourself in dollars, and to hedge your forex risk, you need to short the lira. If you stop the bank from allowing them to short the lira to hedge, then you have a forex risk in the banking system. But the financial situation in Turkey is quite vulnerable. Okay? The data I've seen recently. As for Japan, as you know, they gave a 6.3% decrease in GDP, annualized GDP fourth quarter, as a consequence of moving up the VAT. So this fact, if you add up to the coronavirus impact, probably Japan is going to enter into a technical recession on first quarter. I would keep that for granted. And I think finally, you have a weakness in Mexico. In Mexico, you have seen investment growth in the negative territory the last 2 years. People don't trust the new government. Mexico is in a recession, and it's not that easy to see a recovery in Mexico. Remember that almost 20-25% of the Mexican public expenditure is driven by oil prices. So if oil prices are very weak, this is bad news also for the Mexican economy. So what you're seeing in markets, very, very, very weak Baltic Dry Index. This is the best leading indicator of world trade. Okay, so this tells you that basically we're going to have bad trade figures. It was starting to recover. No longer this is the case. Equities sharply down yesterday. I think tonight Asian markets were calmer, softer than yesterday. But in the case, the VIX, which was very, very low at 13%, is sharply up after yesterday close. Yesterday was the worst day for equity markets since the Brexit vote. The profits of the S&P 500, according to the analyst estimates, used to be at 9.6. They are at 8.1 last week. Probably this is going to come down as you begin to see some reporting and see the first impacts of coronavirus. Very interesting, the yield curve has inverted. It is already at 16 basis points of inversion. I'm talking about the 10 years, 3 months, which is the best yield curve to watch. So this is a yield curve that predicts recessions. Okay, it's probably a technical move. We have to see if it keeps on going forward. Government bonds are going up, not down, sorry. People are taking refuge in government debts. Okay, that's why you are seeing the inversion in the US yield curve, and a lot of people are buying Chinese bonds as a refuge compared to Chinese equities. Weakness in oil price is down 15%. Weakness in industrial commodities, copper price, steel, all these things are coming down because China makes more than 50-60% of the marginal demand of these things. So if Chinese internal demand suffers, then the price of these things goes down, has plenty of implications from many countries as well as for investors. If you're buying commodity companies at a PE of 7 times, yes, 7 times as long as the price of the commodity keeps at this level. If the commodity price goes down, then you have fixed costs, and then you could have a final PE of 14 times. And the only exception is rhodium price, which is going up like crazy. Yes? 10 to 3 months is the best. There is plenty of academic research which shows you that, because you know at the end the 3 month is very pure on what the Fed is going to be doing. The 2 year, it depends on the huge supply of the US government in 1 year bills, 2 year bills, etc. In the past it was okay. Today everyone in the academic world, the best predictor by far is the 10 to 3 months. Gold going up like crazy makes sense. When real rates are low, gold price goes up. Okay, real rate is the nominal rate minus inflation. So as you know, the US 10-year is now 1.3. Core inflation is 1.6. So you have negative real rates in the States now. So people take refuge in the gold. Makes sense because the gold has a disadvantage versus a bond because it doesn't generate an income. If today you have a negative income in a bond, you go into the gold price. And people have been buying aggressively the US dollar, 1.08 against the euro. I don't think this is sustainable. And people have not taken the yen as a refuge this time because of the weakness in the Japanese economy. So conclusions, we're going to have a very bad 2020 growth. I think I told you 2.5 months ago that growth could be 3.3 this year, which was mediocre one compared to 2.9 last year. Now I don't think it will be 3.3. So probably we're going to get 3% in best of cases, which is quite mediocre. Nothing to worry about. I don't think there is a recession, a global recession, but it's a mediocre growth. Okay. We need to see the micro and macro impacts of COVID-19. The key issue here is how many months this situation lasts. It's going to be ending in March, in April, in June. This has huge implications for earnings as well as for the economies. Okay, think not upon the short-term effects in China and the rest of the world. Look at long-term effects, and I mentioned the three. Remember the three first: Chinese real estate and Chinese banking system impacted by a Minsky moment. Second, insourcing. People take down the supply chains from China elsewhere. And three, the contagion effect of lower Chinese demand impacting through lower commodity prices in other emerging nations which have too much debt. Okay, these are the three risks that, in my opinion, are going to be there. And finally, think that the Fed has, ideally, or they said they're going to stop buying bills in March. So in April, you could have a weaker market should not we see a reaction of central banks by announcing new stimulus measures. So the situation is going to be funny coming forward. A few slides left. This is the difference between the US and German 10-year bond. So you used to have a spread of 280 basis points. Today, this is at 200. The difference between these two, this spread tells you, in my opinion, the flow of money going into the euro versus the dollar. That's why I think that coming forward, you should see some strengthening of the euro versus the dollar. Second, when you ask employees, what do you need for your boss? Basically, they say 84% is training for jobs in the future. What I told you guys, I had this insight that you needed a lifelong learning, okay, to face the structural problems of our world, and this is what workers say, exactly the same. Second thing they need, automation impact on jobs, okay? Ethical use of technology, income inequality, diversity, climate change, immigration. Okay, that's why I think lifelong learning is critical. Here it's not about doing more MBAs or masters in finance, which we always have this demand, but basically how we spread out this knowledge into the rest of the people is critical if we want to make an opportunity out of the situation. And finally, you know, I like a lot the happiness studies, and this is basically with whom you have been the happiest the last week, and by far is with your boss, especially men, by the way. Women a little bit less. It's interesting that sometimes you also prefer to spend more time with your friends than with your spouse. I think it's a marginal thing, because you spend with your partner every day 2 hours and with your friends 1 hour a week. Perhaps it makes sense that some people will prefer their friends. No? Children is also interesting. Parents, look at the difference between men and women. And then if you look at unhappiness index, by far people, or they like the least is work. If you look at work, the worst part of work by most people is commuting, by the way. This is what people hate. Okay, and it's interesting that then other things such as religious service is in the positive territory. I think it's interesting looking at this data, because data tells you basically how people react to different input. If I have time, did I give you the class on happiness? No. Okay, I wrote a book on these things, on happiness. So if you want, next time we meet, I'll tell you what the science tells you, and plenty of surveys on what provides happiness and what creates unhappiness, so that you can react based on the data. I think that's it. Thank you very much, guys.
Gracias por aceptar para el evento que estamos por
Un placer.